How you doing? Today it's a special stream. We got a guest. I hardly ever have guests on. I do need to have some guests on. Like I need to get Keep It Techie on. I need to get Jawan on. I mean, like I done been on a lot of shows and I haven't had people over here. It's not because I didn't want to. It's just because I got other things to talk about. I just got so much other stuff to talk about. But yeah, I should have some people come on though. But I just be I just be so um I have so much other content than to do interviews with people, and but it's good to hear other people's stories. But I feel like and also too that some people have told their stories over and over again, and that's they don't want to talk about that. So we will have to find something else to talk about. You know what I mean? Like when I go on other people's shows and they like, how'd you get started in tech? I was like, man, I said this about 55 times. I don't really want to talk about it. I can refer you to a link and you can do an AI summary on it, but you know, I know. That's just me being mean, I guess, but I don't want to talk about it. Yeah, I'll be at the conference. I need to start making arrangements for that as well too. In fact, that week is the week of Sands.org is having a conference that week, and I should be attending that training. I've been debating on if I was going to pay for it out of pocket or go get my PhD, Tim.
Well, the good thing is you have the option to choose, right?
Mm-hmm.
Because I think that's the key is you got the option. So you got some different paths you can take, but it's still gonna end up to the same result based on what Tam wanting to do, right?
Yeah,
Which is good.
yeah. So I've looked at a lot of people like, oh, why you want to go get a PhD? It's not going to increase da 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 da. It's not about that for me. It's about I just want to see if I can complete a PhD. Can I sit down and do it? And I'll worry about the payoff on that later because I think I don't think I've reached a plateau. I think there's still room for growth, but then you have to decide at this point: do you want to have your own business, or do you want to be a CTO in somebody's company, or a VP of engineering, or something like that? And then that gets into okay, well, what's the political game if you go down that road? So, and even if you are doing your own thing, you still got a political aspect of that because you got to bid on contracts, you got to fight with people and so forth and so on. So I don't know, Tim. I don't know. I don't know. We'll see. Well, you ready to get into today's topic?
Yes, I'm ready to jump into it.
Okay.
First thing I want to say thank you for allowing me to come over, and we always have a good time when we have these conversations about, where we at in the year and going into the new year and what we should be doing or paying attention to, as well as, the noise that's going on right now. So I think it's a great time. Definitely want to appreciate everyone for tuning in. You and D always do a great job of sharing the information, but sometimes, the more we just got to keep sharing because sometimes we can be a little hard headed, and it takes a little bit before we stop hitting our head up against the wall. So
Gotcha. Did you restream back to your show?
yes, I'm doing that right
Oh,
now because I was getting
okay.
a air from YouTube,
Okay.
but we
Just
got
making
that
sure.
going right now.
All right, making sure we got your viewers listening in as well too. So one of the big topics we were going to talk about today is 401k contributions, taxes, and so forth. So I'm gonna take a jump out here, Tim, and and we're gonna work backwards a little bit, and then we can backdoor our way into this.
Perfect.
So 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 I use Chat GPT because I just want to see what Chat GPT was gonna say about this, and then we can kind of it'll roll us into our topic for today. So one of the big things that everyone always talks about on YouTube is being overemployed and working two jobs. Well, the other side of working those two jobs, and I've talked about this before, are the taxes, right? So how do you get your taxable income down? How do you contribute to an IRA? How do you contribute to two 401ks? So, you know, for this show, we're going to talk about 401ks, but we're going to backdoor first with this topic and then roll into the whole thing with 401ks. So on my screen, I have here, I'll tell you what my prompt was. And D, you can share this screen as well. It says, I asked, what are the rules to contributing to two 401ks at the same time while working two jobs? Now, I know what they are, but I just wanted to see what Chat GPT was going to pull back um and I start going down in a rabbit hole of this too. I was like, well, if I contributed to 401ks, and the reason why I talked about the 401ks is because I was just looking at what that was, because and we could talk about this too, Tim, the 401k versus the IRA, like while you're working, right? So one of the big things with the 401k, you can take a loan out, but on the IRA, you can't take a loan out. Correct me if I'm wrong on that one.
Well, it's similar but different.
Gotcha.
So you can, yeah, because you could take a loan. Well, you can take up to your principal on the IRA, and it won't be no tax consequence, long as you
Okay.
don't dip into the interest.
Okay. Now every time I go to look at IRAs and I go to take a loan out, I'll never see that option. But I mean, is this coming out of the rollover IRA or just an IRA period? Whatever
Just
what you're saying.
your traditional IRA, your individual that you could get from a brokerage account.
Got you. All right. So here's what it returned. Contribution limits are aggregated across plans, right? So it says the limit for your 401ks for 2024 is 23,000, and if you're 50 and older and you're doing the catch up, it's 30,500. Now the key here is you got to know this. The limit applies across all 401k plans. So that 30,500, you can divide that up by 2 because that's what you're going to contribute to. One 401k over here and another one over here. Now, here's the kicker with all of this. The kicker is which company is matching the most. Because you'll get, and I've been in this situation, one 401k plan wasn't contributing nothing. The employer wasn't doing nothing. They were just like, we got a 401k plan, you can contribute yourself. Then you had another 401k plan where they're doing anywhere from 4 to 6%, right? So it depends on what the employer is doing. Have you been in this situation before, Tim, where you had two 401ks and you had to pick and choose? Or have you been in a situation where you had one 401k and the employer wasn't doing anything?
I would say at one point, yes, I had two 401ks, but that was a long time ago.
Mhm.
I had two 401ks, and I ended up stopping one because they did not have the best options as far as their funds. So I went with the one that had the better options, and they had better matching at that time.
Okay. So you
Yep,
just you just you just said the other one, I'm not gonna even deal with it
that's
because it's
correct.
not. And it what and what do you consider And at that time, what was considered better options for you? Was it the fees or the funds that they had to choose from?
At that time, it was just the funds because I wasn't thinking too much about the fees, to be honest with you. But by me making actually sitting down, trying to go through, looking at the funds, that's what made me pay attention to, well, there are fees for this. Because initially I used to think that your 401k was cheap. So, we get the concept of thinking that I thought was, at least for me, I was thinking at that time it was free.
Mhm. Yeah.
So,
And that's the other thing too, like in your employer plan, you need to look at the fees. In fact, I encourage you, like, don't call and talk to the help desk, right? And be like, hey, not the people that help you change your account password. Don't talk to them. Call and set up a time to talk to someone to explain your 401k plan, the funds that you're in, the fees on those. Um, should you be in a mutual fund, or should you be in I forget, a target date fund, or should you be like, understand what those things are and understand why, and you could probably even ask the plan manager at your company, like, why did y'all choose these things? Like, because at some point somebody had to pick and choose based upon the company size, XYZ plans, and that might have been what they offered. But I think now, with the 401ks now, I think it's mandatory now that companies are automatically enrolling people into a 401k coming up in 2025. I think that's automatically, like, you don't, you, whether you check the box or not, you're gonna automatically get enrolled. So that could be a good thing, and that could be a bad thing. The good thing is you enrolled. The side, the I guess the little asterisk on the side is, or the star is, what are you enrolled into?
yeah, that's the question.
What are you enrolled into? And so look how to review those plans. So, let's talk about it for a little bit right there. When you get a 401k plan, what's your approach from an employee perspective? What is your approach to sit down and review what you're getting into? Do you go through every line item, every single one, or do you just look at the returns on those plans and then just invest in them? What's your approach, Tim?
Well, right now I actually do it based on my risk assessment and then the asset allocation. And then
Mhm,
I look at basically when I look at funds, I look up for three things. I look up what is their turnover rate. Um, and what that means for people that may not know is the turnover rate just means if you're thinking about a mutual fund, how long do they hold the funds inside of that mutual fund and they change them out to something that may be better, more comfortable? It just depends on what the fund objective is. That's what I look for, is one. The next thing I look for is I do look for sometimes the rate of returns, because I want to know, is this fund going to make me money? Because it's ultimately why I'm investing in it. So I look at the track record. I look at the last year. I look at within the last 5 years, and then since inception. That's the kind of
mhm,
things I do to bounce it off of. And then I also look for is do they pay dividends? Because I look at that as a 2 for 1. If I'm investing in it, I get appreciation, and appreciation just means the cost of the investment goes up, but also they pay dividends for me investing in them. So they basically give me a kickback for me investing with their company or that particular fund. And then the last thing is I look for what I didn't used to, but until I got more seasoned in the space, I now look for the tenure of the fund manager or the custodial.
mhm,
Because why did that matter? Because it's just a direct correlation of if they're more newer, they're more likely to, one, have a higher turnover, and two, it's harder for them to have the track record that you're looking for based on your retirement objective. What do I mean? So if you know you're looking to retire in another, let's just say 10 years or so, I'm not necessarily looking for someone that's going to be in and out. I'm looking more for someone that's going to probably be there a little bit long term. So they make sure their focus and their objective of the fund is going to be more long term in line with the fund. So
Got you. And I look at the same thing. I look at, um, well, a couple of things. I look at the return, and then I also look at what is the percentages inside of it, right? So in that fund, are they invested in tech? Are they invested in energy or what have you, whatever the case may be? But I'm also looking at the percentages of that as well too, because I've invested in some funds that said they're supposed to return at least 8%, and it returned negative while I
yeah,
was in there. I was like, oh no, we got to get on up out of this, right? So I look at that as well too. But again, when you get your 401k, you get it, it's coming out of your check, pre-tax. But where does the money go? Like, another big thing too, and I've never had this before into this job is, they'll take the money out, but it don't hit my 401k immediately. So say you get paid on the first, the money may come out, but it don't hit to like the 20th. And I'm like, well, what is it? Where the why it take you so long to get my money to my account?
right,
Where's my money at? Why I gotta wait? The month is almost over. So I don't make so to me, I feel like I don't make money that month. I don't make money to the next month. Right. So understand when does your money hit your account? That's another thing that you all gotta start asking questions about, because you just don't know what it looks like, right? So on that same question from ChatGPT, the second one says, employing employer matching contributions don't count towards the employee contribution limit. It says each employer can match contributions independently, and these matching amounts don't count toward the $23,000 limit. So in other words, the employer can put in 20, 30, 40, 50,000 that year, but your 23,000 that you putting in is going to be on you. But there's a caveat to this. There's a but to this. That but is, they fall under a separate higher limit, the overall contribution limit, which includes employee contributions, the employer matches, and any other employer contributions. So for 2024, the overall limit is the lesser of 100% of your compensation, or 66,000. And then, or if you're like 50 and older, it's 73,000. So those of you that are up to 50, and really, and correct me if I'm wrong, Tim, the year that you turn 50, which is 49, the year that you turn 50, you can do catch up contributions too, correct?
that's correct.
Yep. So let's say we probably want to say 48 or 48 and a half. I don't know how
Right.
we want to do that, right? But again, so between you and the employer, you all can be putting in 66,000. However, if you're 49 and a half or turning 50 that year, it'll be 73,500. So imagine every year you had an employer that's contributing, all right, to your contributions, and you contributing, and y'all get $73,000 in. Now, what do you think? And just humor me on this one. What do you think the average length of time people are working jobs right now? What do you think the average is?
I say right now the average is about 68.
the number, no, not working years, but how long, like if you start a job, what's the average time a person is working jobs now? Is it a year, 2 years, three
Oh
years?
yeah, it's about 2 years. About the average a year to 2 years is the average time that people is working and staying on jobs.
Mm, 2 years. So basically, what we're saying is at the end of 2 years, depending on the contributions, we could just multiply. I'll just go in the middle, 70 times two for average. So about 140,000 could be in your 401k in 2 years, depending on the employer, what they
Right.
contribute. Right? If your employer is not doing anything and you're doing the 23 and the 23 for them too, uh, well 23, and then of course it increases the next year. So we'll still do an average there. That'll be at 46, right? So we can go from 46 to what 140, right? Between 2 years. Now the question becomes is, Tim, what if you're contributing to your maxing out your 401k? Should you be max should you be maxing out anything else?
Yeah, so if you max out your 401k, you should also be maxing out your IRA.
Oh,
They go hand in hand. And the IRA limit, at least for this year, which is not changing, and we'll talk about that, is 7,000. So that's another 7,000 that you should also be putting away. And then we go one level to that, which what we're gonna cover today is then the the HSA. So
right. So we got so let's add it up. So we got 7,000, right? And we're gonna divide that by 12. So every month you should be putting away 583.
yep.
All right. And then we'll do 23,000 and we'll divide that by 12. 1916 or 1917. So 1917, let's back that up, plus 583. 2,500. Are you contributing 2,500 a month? 2,500 a month. That's a lot. You think
Yeah, it's
people
almost 30 grand a year.
so 30 grand a year. So that means that your job can't be 60,000 because you
Well, it
only
depends on you. It depends on where you're living at, because we had a stream before where 50,000 is great income. So
yeah, yeah. So we can't we so we and this is puts that in perspective. So we're gonna multiply that by 12. That comes out to 30,000. So 30,000 a year. So now the question becomes is, and this is pre-tax. This is pre-tax. So if I'm just gonna play the numbers game. We're gonna do 60,000 and we're gonna multiply that by 0.7. That's 42,000. We're gonna divide that by 12. That's what you pull at home a month. And we're saying that you should be maxing them out. We ain't talked about the HSA yet.
right.
You ain't got no money. You don't have no
Bottom
money.
line.
You don't have no money. That's just again, I'm just trying to show you numbers that when y'all think about these things, like you're like, why I want you to get to these certain income levels so you can have this conversation and do these things as well. All right. Last but not least, it says, and it goes into tax planning strategies because I asked about it. If you accidentally contribute over the limit, you'll face tax penalties. Excess contributions may be corrected by April the 15th of the following year. Otherwise, they become subject to double taxation. Tax both when initially contributed and again when distributed. So you have to fix that if you went over the 66 or the 73,500. Another one they talked about the employer offers a 403B or a simple IRA or any other retirement plan. The contributions limit vary based on those. And it says tax planning strategies. Contributing to multiple 401ks could impact your tax bracket and overall tax strategy. Some individuals prefer to allocate more to one plan over the other based on the factors like investment options, which we talked about, employer match levels, and fees associated with each plan. We talked about that. A financial advisor or a tax professional can help you optimize contributions while avoiding excess contribution penalties. And they went on to give like a little tax strategy here. I just wanted to see what they was going to say because I asked. It says if you earn income from two jobs and want to max out your employee contributions to both 401k, you should contribute, say, 11,500 to each plan, but together they can't exceed 23,500. Now, here's the thing we said before. If we scroll back up, that's the factors are these: the investment options, the employee match levels, and the fees associated with each plan. And you need to look at this whether you got two 401ks or one 401k. That should be what you're looking at across the board, right? So now we've talked about, say you work two jobs and you got a 401k plan or IRA or whatever. Now we're gonna turn it over to Tim. And I told you, Tim, we were backdooring. So now let's talk about it.
Let's talk about it. So
And I
now
stopped
when
sharing my screen.
I'm sorry.
I said I'll stop sharing my screen.
Yeah, so now when we talk about the 401k, I think do you want to just go ahead and cover the changes that's coming up, or you just want to
Yep.
talk about the plan itself?
No, let's talk about the changes that's coming up, and then we can talk about we can go back and talk about the plan.
So yeah, so one of the changes for 2025 is the limit is going up by $500. So for 25, you can contribute a total of $23,500. So it's going up by 500. And then also if you age 50 or older, you could do additional 11,500, I think it is now, in catch up.
Oh, you said 50 and older or 60 and older?
Oh, yeah, I'm getting it. Yeah, it's two
Yeah.
levels too. I'm
Yeah.
sorry. So for the 50 and older, sorry about that. You could do additional $10,000 in catch up. And then if you age 60 to 63, you could do additional 11,500.
Yeah, they're calling it the super catch up.
Yep.
Yeah, that's what they call it, the super catch up right here. Let me scroll. Let me see if it's a little thing down here about it, cuz I was looking at it, and it's broken down a couple of different ways. Oh yeah, here it is. So for those that are ages 60 to 63, they will be eligible for increased catch-up contributions in their retirement plan. This applies to the 401k, the 403b, and the 457b plans that currently offer catch-up contributions. It said the enhanced catch-up contribution limit is $10,000 or 150% of the standard age 50 plus catch-up contribution. So for example, they give an example here. They said the catch-up limit for age 50 and up is 7,500. So the IRS just announced for 2025 the enhanced catch-up contribution limit for those 60 to 63 is 11,250. It says to qualify for the enhanced catch-up contributions, participants must meet specific criteria though. Be 60, 61, 62, or 63 by the end of the calendar year. Generally already contributed the maximum deferral amount. And it says no, once participants turn 64, they revert. They only giving you that 60, 61, 62, 63. Once they hit 64, it's gonna revert back to the catch-up contribution, the 50 and older catch-up contribution. So it's limited. So it says from 60 to 63, we're gonna let you get that 11,250 in, or 34,750 a year. But once you hit that 64, we're snatching that back. We're snatching your wig back, and we're gonna put you back at the 31,000 total contribution limit. Why they gotta play them like that? Why they can't continue to contribute all the way up until 65, Tim? Why they gotta play people like that?
Yeah, it's it's almost it's almost forcing you where what people also have to know is they've got to be conscious of what their plans are doing. Because if not, then I'm pretty sure they're gonna probably have a penalty somewhere. I don't know what that is, but normally if you over the limits based on what it is, it's normally like a 6% penalty.
Yep.
It's
And
4 to
put a one in
6% penalty.
Put a one in the chat if y'all following along. Put a two in the chat if you're not sure. But we're talking about your 401k plans, your catch ups, the changes. We and again, we gotta keep up with what's going on. We just had an election this year. I mean, we just did our voting this year. We saw the outcome of that from the voting, but do you know what effects that are gonna be coming down the pipe from from this election? What ends, what starts? I don't know if y'all been keeping up, but I've been keeping up. I need to know what's gonna affect me, who's doing what they changing, how we investing, what we investing in. Yeah, we got that stock market little bump last 2 days. Let's see if that continues for the rest of the year. Let's close the year out with a bang. I got a goal I'm trying to reach for the end of the year. Hopefully I can get there. Hopefully I can get there. We'll see. But yeah. All right, Tim. Oh, back over to you. We did the contribution catch up. I mean the contribution plan, and it's 60 to 63.
That's correct. And then on top of that, you have the IRA, the Roth IRA and the traditional IRA. So all the IRAs, their limits didn't change. They still at the $7,000 per year. And I think people need to definitely leverage that. I think the Roth IRA, in my opinion, it can be a game changer for, in a sense, it could, to me, depending on your individual financial situation, I think the Roth IRA has a lot of great benefits because you don't have to necessarily jeopardize your direct retirement in your 401k. You could use the Roth IRA to get you other assets. And the reason why is because they also have where you could withdraw up to the principal and you can use that money to get into real estate. That was one of the things that I done. I
Okay.
utilized my Roth. I took out, didn't go over the principal, what I put in, but I was able to take that money and use it as a down payment on my first rental property. And I did not have to affect my 401k. Now you can do that because the benefit there is you can pay yourself back. However, it just depends on, like I said, that's why the great thing about finances is no one way to do it. You could get creative, but you can get creative, stay within the guidelines of the IRS, do everything legally as you're supposed to, but you can still make it tailor to your financial makeup and your financial strategy.
Now you said you took a loan out on your Roth IRA, or
Hmm.
you just pulled the money out
I
from
just
your.
pulled the money out
Okay.
because I looked at it as taking one asset and using it for another asset.
Oh, so you just pretty much shut down the account.
No, no, no.
Okay.
So I give you an example. So
Mm,
I had at that time, I had 20,000 in it.
mm,
10,000 of it I contributed, and the other 10,000 was from the growth.
mm.
I took up to 8,000 and used
On
that as part of the down payment,
on
and
the
then
Roth
left the other
side.
12. Yep, and
On the
left the
Roth
other
side.
12 in there. Yep,
Yeah.
that's correct.
Yeah. So you took a withdrawal on the Roth side.
Hmm.
All right, that makes sense.
Yep,
Right. Would you say D? I did the same with a rollover IRA, but into a REIT, no penalty. Yep.
yep.
Now there are some limits on this Roth IRA. For 2024 and 2025, the yearly income restriction is phased out from 146,000 to 161,000. So I just want to point that out when people are looking at Roth IRAs. There are some income limits on those Roth IRAs. So if you're at the 200,000 and contributing to a Roth IRA, you may want to reconsider.
Right. Or you can do backdoor, but that's a little bit more advanced.
Yeah, 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 yeah. You can do a backdoor, but that is a little bit more advanced. And I think what's the new income? Is it 70, not income limits, but is it 76,000 still on the backdoor?
That's correct.
Yeah.
Yeah.
Yeah. Yeah. Does anybody know? Put in the chat if you know what a backdoor contributing to a backdoor Roth IRA is. Like put a 1 in the chat if you know, put a 2 if you don't. I wanted to make sure y'all understand the terms. I don't know if you want to go down that rabbit hole, Tim, or not.
We'll say that for another our part 2 to this.
Okay,
Cause
just
cause
making sure.
cause it's some things you got to consider when you're doing that, because you really got to also think about your tax strategy and know where you're at tax wise before you just, kind of jump out the gate doing it. So
Peter Investor, how you doing? When y'all hear tax strategies, do y'all understand what we're talking about? Do you understand how contributing to your 401k reduces your taxable income? Shout out to you, Peter Investor, for the $5 super chat. We appreciate you.
salute
Do
to
y'all
Peter
understand
Investor
that?
M.
Yeah. D- I don't know if y'all understand it. Okay, so when we talk about reducing our taxable income, the reason why that you contribute to your IRA and your 401k is so you want to reduce your tax bracket, right? I want to be able to hop into another tax bracket. Now, I think it's hard too to hop into to go from was it a 35 percent tax bracket down to like a 12% or 22%. I don't know. I can't get that far, Tim. I don't. You may know better than me, but I haven't been able to jump that many tax brackets.
Yeah, that definitely requires a tax. You need a CPA and a tax person that's all they do. Um it's some ways you can do that, but you gotta really have somebody that understand the laws to a T.
Yeah,
But yeah, that's a good ways to go.
yeah.
And the biggest way that most people do it is through real estate, through cost segregation. But
Okay.
you know, that's that's very that's very technical, because you got to know, how much you carrying over. You got carryover limits, so forth and so on. So
Now I'm gonna ask you a question. I know the answer to it, but you tell me, would you do this? Because I hear a lot of people on the internet talking about it. I have my 401k. I have say $800,000 in there.
mhm.
Should I take a loan out for my 401k to go buy a house? You would you? This is not this is not financial advice. Would you consider that? And if you did, what would be your reasoning for considering that?
So for me, based on my knowledge base, I would say no.
Okay.
Okay. And now, if it's a rental property, yes. Primary residence, no.
Okay.
Why would I say no? It's because if you're going into your retirement to purchase your first home, then what are you going to do when you need to maintain your home?
Mhm.
So I think that's one, because you're not getting a whole lot of benefits for your primary residence. So if it was a rental property, that can be different, because you can have two things working for you, meaning you can have generate income, a cash flow, but you also can have equity, and then you can take and utilize the equity to change your financial situation based on your strategy. But if it's your primary resident, you don't necessarily have that leeway, right?
Mhm.
Or now, if you do decide to refinance, but it's going to take some time to do that, now you got additional costs that you're about to add, because you got closing costs, so forth and so on. So I wouldn't necessarily recommend that, but that really depends on the individual and where they at and where their income is at. Do they possibly got skills that they can now leverage outside of their 9 to 5? So it's really is a little bit more complex, but I would say initially no.
Got you. Got you. Only if it's a rental property.
Right.
Only
Hmm.
if it's a rental property, right?
Or some
And we
type of flip or something like that. That's
right,
the only way.
right. And then what we've seen, the market is crazy right now with the storms. And I'm not talking about storms just in Florida. I'm talking about storms across the Midwest, tornadoes, even with the storms coming off of Florida and going into like North Carolina and so forth and so on. Like the weather has changed a lot of things. I'm wondering if they're going to start coming out with new housing ordinances because of the weather across the United States, not just Florida, but just across the United States. Like you could look at some of those tornado videos and you can see how they just ripped up homes. Like we s- s- we pulling homes off the entire slab. Like what does that look like? So I'm just curious as to what the market is going to look like over the next couple of years. What the housing market is going to look like over the next couple of years, and where do you fit into that? If you're renting or owning or have rentals or buying land or flipping, whatever the case may be, I'm just curious of what that's going to look like going forward. But I do agree with not taking a loan out unless you're planning. And you got to remember that loan is what, when you take it out, it's for 5 years, and you
Hmm.
got to pay yourself back with interest. And then that's the other thing too. When you do take that loan out, you need to know how much interest you got to pay back. Like I looked at the one that I had from ADP. The interest was 9%. I was like, who want to do that?
Right.
Who want to do that? And I was like, and then I have another account where it's like 3%.
Right.
Right. So why would I want to give you? I know I'm paying myself back, but now it's a penalty to pay myself back as well too. Plus, the money has to be moving and operating so I can make those payments back on that loan as well too. Because that's the goal, right? The goal
Right.
is not to come out of your own pocket. The goal is to go in, obtain whatever property that is, and then have those payments being contributed back to that loan, and and a profit.
Right.
You want
There
a
you go.
profit. I mean, I'll break even. I'll take breaking even, but I want a profit, whatever that profit is, right? So you got to make sure you're making the right decision on that.
Yeah, and I just want to expand on that for a second. And I think because the thing is why I also don't necessarily recommend it, because when you do it, and if you don't do it right, you just now jeopardize your retirement.
Hmm.
So I think it's important that if you're going to anytime, I just look at it as anytime a person is going to take a loan against their retirement, the question is what you're doing going to be part of the replacement to pay yourself back? And if the answer is no, then that tells you it's probably not the best thing to do.
So
But if the answer is yes, then we can now explore a little bit further to see how everything works out in your favor.
all right. So what you're saying is, don't go take the loan out if I need to buy a car.
Absolutely not.
I can't go buy my Hellcat.
No Hellcat, no vacation to, the Bahamas.
I can't take this money out for my wedding. I'm gonna
No,
pay it.
nope.
I'm paying it back.
Nope.
Oh,
Yeah,
come
yeah.
on.
If you take it out for your wedding, you got some other considerations y'all need to do.
I can't take it out for my wedding. I can't take it out for a car. What if I want to buy our first home as husband and wife? We both want to take out and buy our first home together.
So my question then would be is Why don't y'all first save up, set a goal to save up, I don't know, 5,000 a piece, save up 10,000 and then come back and reevaluate.
Okay. What if we got the 10,000 already there, but we need 50,000 for a down payment?
Okay, so then it would still go to what is your situation based on what you're going to get. Is you going to be something that you can get as a primary that you're going to stay there till the very end? Or is what you're getting is going to be a place that you're going to get now, but you see yourself eventually renting it out. So if you're going to get it and you got the preconception that you're thinking that it's going to be in that rental because you want to have a rental property, then that may be something to explore. But again, it's all about the strategy. It's not just doing it based on right now, it's doing it based on what I'm gonna do right now, how it's going to affect my future outlook based on what I'm trying to do financially.
Understood.
Mhm.
So
And,
again,
and
don't.
here's the reason why I say that on that in that same vein. It's because now you may factor in, you may have kids. So
Mm-hmm.
now everything changed. So now you may not be able to get back to because now you got another mouth to feed, and the child's outlook and outcome is the most priority. So at that point, what your plan initially was may shift or change, but you didn't factor that in. Then you could be caught, kind of in more of a tighter situation. So
Right. So now I guess my question, my next one is, with your 401k and your IRA, we talked about the limits. Did you want to go into the filing status for 2025?
yeah, so for the filing status just another down that vein of taxes. So the standard deduction is going up by 500.
What does that
And
mean when we say standard deduction?
so the standard deduction is it just gives you the number that the IRS set that you can write off against your income. So let's just say if you make for simplicity, you make $100,000 and the standard deduction for a single person is 15,000. So instead of the IRS charging you on that whole full 100,000, you get a chance to subtract 15,000 from that. So now the IRS only tax you on 85,000. That's what standard deduction is. And then it's broken down based on the different tax status that you are. So you could be single, you could be married filing together, filing jointly, married filing separately, and then you could do head of household. And
Got
head
you.
of household is pretty much for somebody that's single that has dependents. Yeah.
Yep. So if you're single with no dependents, you would just file what? Just single.
Yes, you just
So
file single.
yep.
Yep.
And so
And oh, go
go
ahead.
ahead. No, go ahead.
Yeah, so for single, the new status is going to 500, I'm sorry, 15,000. It went up by $400. And then if you married filing jointly or you a widow that's a surviving spouse, then it's going from 29,200 to 30,000. And then if you head of household, it's going from 21,900 to 22,500.
All right, so now let's talk about this. D, let's bring this back up. So we have you're single, and let's say you fall in this 24% tax bracket. You're single, and your standard tax deduction for 2024 is 14,600. Now, let's say you made 150,000 in here. That's
Hmm.
not that you need to work on getting this 24 down to at least 22. That's really what you want to do.
Right.
So, and the edge of 22 is $95,375. So let's go here. You had 150,000. And we're gonna go to 95,375. Whoo, woo! That's a long way to go, Tim.
Yeah.
All right, let's start. All right, we're gonna start with you single.
Right.
You made 150,000, right? We
Mm-hmm.
know to get to the next tax bracket, we got to go down 54,000, almost $55,000.
Yep.
So we're gonna start. We max out our 401k, and I'm gonna do this a person under 50.
Right.
All right. The next one is the IRA.
Right. That's another 7.
That's another 7,000, and then our HSA. I'm gonna throw it in there for right now.
Mm-hmm.
4150, right?
It's 43.
4300.
Well, for 25, it's gonna be 4,300. But you're right for this year.
4150.
Yeah.
You still got $20,000.
See, that's where that one rental property coming into play.
Right? You got $20,000 you still need to get down to bring down your taxable income. We're trying to get you out of the 32 to the 24. So
Right.
you still got 20,000 here. Let me tell you what they tell me. Do you have $20,000 that you can contribute to a nonprofit? Did you give away or donate $20,000 worth of clothes?
Mhm.
Did you donate to somebody's scholarship fund or whatever? Now I asked this question. I said, can I contribute $20,000 to my own nonprofit? They told me I could, but there are some stipulations
Revelation.
around around me contributing to my own nonprofit. All right. So what I'm telling y'all is if when you're making the 150, the 200, 300, the 400, the 500, the taxes, it's going to eat you up.
Mm-hmm.
You've got to find a way to find tax shelters. Now, I'm going to tell you this. All the YouTubers that I see, they lying to y'all because they tell y'all about all these tax strategies, but they tell y'all about the tax strategies as if you're an entrepreneur. They don't tell you about these tax strategies as you are a regular W-2 employee making 2, 3, 4, 500. They don't talk about that. No one talks about that.
Facts.
And I'm telling you from my own experience, when I reached out to, hey, we can tax strategy, you call them, they were like, are you self-employed? No. Do you own a business? Uh, I do, but I ain't doing nothing in it. Oh, we can't help you. It's
Facts.
always from an entrepreneur or business mindset. So when you see all these people talking about all these different tax strategies that how they got around and how they did this, they lying to you. I'm just,
Mhm.
I'm sorry. I hate to be pocket watching with JT, but I'm just telling you.
And let's go one step further on that. Even
Yeah,
in the real estate space, right? Because a lot of people, you know, so myself, I own real estate, but I do know that me being just having some rental properties is still different. And I still have a threshold on what I can write off compared to somebody that this all they do is real estate. They consider a real estate professional. So they can almost write off 100% of what they do. And but they don't necessarily talk about that part. It's going back to your point. It's almost like they just blanket everything as cookie cutter, but the IRS already thought out, well, it's not necessarily the case for this person, which is an entrepreneur. This is all they do. So they get the I say the pinnacle of all write-offs and things like that, compared to somebody that works a 9 to 5, but also may be part-time entrepreneur, whatever the case may be. They have a little bit more thresholds, or they got boundaries now
Mm-hmm.
and it just makes it a little bit very convoluted.
So Tim, I got $20,000 that I gotta make up. What I gotta do?
Well, one of them is you could try some alternative investments. That's one.
And,
Um,
and when you say alternative investments, are you talking about REITs or are you talking
um,
about
it could be REITs, it could be private equity, it could be venture capital, it could be starting up, you investing in somebody else's business idea, long as they got that proper paperwork to support it and they file actual tax document, then that could be part of your write-off.
got
It
you,
just depends on what that may be.
got you. But I hope y'all get a chance to see now what I'm talking about. Like, okay, now your standard tax deduction is 14.6, right? I guess I could take this out too, right? This 14.6.
Mm-hmm.
All right, so I'm minus. We're gonna go ahead and take that out. Now I'm down to about $6,000.
We still got a ways to go.
Still got a ways to go. I done took out my standard deduction. I took out my 401k, my HSA, my IRA. Now, now I still got $6,000 that I gotta figure out. Or if not, they gonna hit me with the penalty.
Mm-hmm.
They gonna hit me with this 58.75. So you
Yep.
better start contributing somewhere, something. And by the way, contributing to your whole life insurance don't count.
No. No.
Yep.
Because that's a
Contribute.
trade-off. Because in your whole life, you get a chance to the death benefit. There's no tax, so the trade-off is okay. You invest in there. You making interest on depending on how it's set up with variable, so forth and so on. But you making interest there, so you're not getting no benefit for putting it in, but you get all the benefit for what comes out. So it's a
Mhm.
trade-off there.
Yep. So I'm still down to this 58.75 that I need to figure out where in the world am I gonna get that from. Now, here's another cold killer here. This 58.75. The guy asked me, he's like, "Have you donated any clothes? What's the max you can do on donations now? What is that max? If when you don't have receipts, what's that max now?"
I think that's I don't think it's over $1,000. I don't think so.
Yeah, I don't think it's over a thousand
Yeah, I
dollars
think
either.
I think it's like 3 or 400.
Yeah, that's what I thought was like $300.
Yeah. Cause that got reduced when they increased. So what happens with that? It used to be more, but when they started to increase the standard deduction, they started to decrease some of the itemized deductions.
Hmm.
So they want to make sure that you ain't gonna keep making all this money, and you
Nope.
they're getting smarter with the laws as we getting smart with trying to get rid of this 5800.
Trying to get rid of this 5,800. I'm trying to help you out. It says for 2024, it says there's no limitation on itemized deduction as the limitation was eliminated by the tax cuts and job. This is what it say right here. But I know when I filed my taxes, the guy was like, "There's a limit." I think the limit. Oh, and also that's what it is. The limit is also based on your income. So right here, the modified adjusted gross amount used by taxpayer to determine a reduction in the lifetime learning credit is not adjusted for inflation for taxable years beginning after 2020, December 31st of 2020. The lifetime learning credit is phased out for taxpayers who had a modified adjusted gross income in excess of 80,000 or 160,000 per term. So you don't get anything. That's what it was,
Right,
Tim.
right,
You don't get anything. Yeah, for personal exemption for taxes, year 2024 remains zero as it was for 2023. The elimination of the personal exemption was a provision in the Tax Cuts and Jobs Act. Yep. Let me see if they got it up here. Let me see what it starts off with. These are just the adjustments that they talk about. The alternative tax exemption, the earned income tax credit amount. That's for people with 3 kids or more. For tax year 24, the monthly limitation for the qualified transportation fringe benefit and monthly limitation for the qualified parking increases to $315, an increase of $15. Yeah, I'm not seeing it though there. Oh, that's the other thing too, Tim. When you're working 2 jobs, you're contributing to Social Security twice
Mm-hmm.
and Medicare twice.
Yeah, they eating.
They're contributing you, so you contributed Social Security twice and Medicare twice. Now, I think that does come back to you because you're contributing twice. Is that right?
Yeah, so you contribute up to a max per year. I think the max was 15,000 and something. I can't remember, but you hit a threshold and then from there on out they stop taking it out of your paycheck. But
Mm-hmm.
what does that mean? So when they stop taking it out of your paycheck, that's just more money now get added to your tax burden.
Mm-hmm. And so you have to put away for that tax, that 5,800 that you gotta get ready to kick out. So again, I'm just walking you through because we're getting ready to start going to tax filing season. Let me go through the history of what we did. We took out money for. We're trying to get you reduced down to the next the next tax bracket. It's 54,625 that you got to make up. 23,000 if you are a 50 and below, or 49 and a half and below, 7,000 for the IRA, and this is all for single people. I'm just talking single. And 4150, so that left us with 20,000. And then we took the standard deduction, which was 14,600. We're left with this $5,875. And then we could
Mhm.
take out, I think, what we say about probably like another 300. But either you're contributing somewhere to it, doing a donation somewhere, or you got some money set aside to pay this tax, or you're gonna get hit with this penalty. So again, you need to find a way to reduce your taxable income and not have to pay back the government.
That's correct.
All right. So now in here, Tim, you talked about the FSA and the HSA. What is the differences between the two? And do people still offer the FSA now? Is that still being
Mhm.
offered?
Yeah, it's still being offered
Okay.
because some people don't want to pay the high deductible. They don't want to deal with the high deductible plan, especially it would make sense if they have more health concerns. So they would probably more or less go with the FSA.
Okay. And so for the FSA, what's the I don't even know. I haven't had one in such a long. What's the FSA limits now?
The new limits is going to be 4,300. I'm
Okay.
sorry, that's HSA. The FSA, I don't remember off the top of my head.
I think you got here 3,300 with
Yeah.
a 660 carryover limit if the plan
Mhm.
permits.
Yep.
So we got some here for 2025, 4,300 for individuals and 8,500 for families. And then they say people 55 and older can make catch up contributions to the HSA. That's the HSA, sorry. For the FSA, it's 3,300 limit, and people 55 and older can make catch up contributions. But you know what I found with the FSA? If I didn't use that money at the end of the year, I lost that money.
It shouldn't be that way. It should be a rollover. It should roll over to your health account because
For
of the
for the FSA,
oh, yeah, for the FSA, no.
yeah, yeah.
HSA, yes.
HSA, yes. The FSA
Okay.
didn't roll over nothing.
Nope. And if your plan don't allow it, that's what one of the caveats. If your plan allow it, then they can do up to the max amount they're allowed to roll over is only $600 and some dollars. But your plan has to be part of that. And most people plans don't allow the rollover. And it will make sense because the paperwork they have to keep up with to do that.
Yeah, that was 2022. I'm gonna go back and see if I can get the one up where I was just at.
So that right there, though, if you subtract that out, that'll bring you down to about 1,000 and some, 900 and some dollars, at least for the HSA.
No, remember I already included that.
Oh, you already included that. Oh
I
man,
included
we
the
done.
4150. We still at 5,000.
We done.
We done. So we gotta have something else. So single people, you all have to figure out a way to get your taxable income down. I know this sounds like over your head, but I'm telling you from a perspective of when you start making more money, this comes up a lot. Especially when you go to file taxes, it comes up a lot. They were like, "Well, you owe the IRS $5,700. Would you like to pay today?"
Yeah,
And then,
that sound
yeah,
like my last, my last tax bill year before last.
and then they hit you with this one. You said, "No, I'm gonna set up a payment plan with the IRS." Then the IRS hits you with 15% or 20% taxes on what you already owe. So now it go from 57 to 7,000.
Yep. And then if you're gonna do it electronically, they're gonna tax you to use a debit or credit card.
Yep. So you $7,000 in the hole. And you got to figure out how you gonna get that money, how you gonna get that taxable income down. Now, another thing you have in here, which could be helpful, is you have the gift tax. Now, you want to talk about the gift tax exclusion there on that one?
Yeah, so the gift tax exclusion is basically for if um you're gonna give kind of this fall money more under estate and estate plan and stuff. But the gift tax just basically mean that, let's just say, for example, if I pass and I gift Tam over all my assets, then I'm thinking of the state exclusion plan. I'm sorry.
Yeah,
But the
yeah.
gift tax is for, so let's just say if I got $50,000 and I gift over that whole 50 over to Tam, then for me, I can only get a benefit for up to 18,000 of that. That's what that means.
Yep.
And it's some other stipulations there, but that's it in a nutshell. The gift tax just means that you can have a write-off for that, but it's not a whole lot, because most people that's just gifting money is gifting, substantial amounts of money. And it's to really make sure that you just can't be gifting money to family members and basically abusing the tax system. So
So here, so here's the question: it if I want to gift, say D 5,000, that's $5,875.
Mhm.
Is there certain paperwork I need to fill out to say that
Yes.
this is a gift?
Yes.
Okay, and that's on the IRS website.
Yeah, it's an IRS form that you have to fill out.
Okay,
Yeah.
let me look it up. Give tax IRS form 709.
Yep. I'm not, so first thing, y'all, I'm not a tax specialist. I just know a lot about the laws because I had several experiences in a few areas. But yeah, you have to fill out that form.
Yep. So here's the form. the donor's and first name, the address, and so forth. So for those of you that are out there, when people, and I may have to do this, they be borrowing money from you. You may be like, I gotta gift you this money. Fill this form out and get it back to me.
Right. So I can get a write off because you
So
ain't
I
gonna
can
pay
get
me
her.
back.
Yeah, I can get a write off. I'm
Yeah,
gonna
at least can
gift
give me some
you.
write off. You ain't gonna
I
pay me
need write
back.
offs. I'm gonna gift you this money. I'm just trying to look out for you here. Now, the other one you had in here is the estate tax inclusion. That's what you were referring
Right.
to the first time.
Hmm.
And you're saying that's 13.9 million from the estate.
That's right. And
You
then
want to
everything over that you want to be taxed.
Okay, do you want to explain what an estate is?
Well, estate just basically means that if you pass, or you can have a state could be a living estate, or it could be a state upon death. But basically, all the estate just means is that you have assets, you have things that's of value, and they continue to make value, the value and continue to increase as time goes on. And with that estate, you just got a document that states this is how I want to manage and maintain said assets. The state is different forms of estate planning, but the key ones that most people look at is estate trust falls under estate. Um, and you got to live in a state and you have a death estate. It's different names called for them because it just depends on what are you trying to do. Some people, when you get ultra wealthy, they put family offices under the estate. Basically, family office is just a business construct that allows all the money to fund back through the family in that enterprise, right? Then you have for estate plan in this case is we just going to talk about if you have, let's just say 3 houses, 2 cars, let's just say you got some collectible coins and you have very large investment accounts and you want, your daughter to get said estate, but then you don't want the daughter to squander the money. So you do a set up a estate plan where she can get the executor or trustee is appointed for that estate, and then you can set up the rules on how you want to distribute the money, how you want to distribute assets, all of those fun things. It's very technical, but it's a simple document to just let you know that while you're here, one, somebody else can manage how things get dispersed amongst your beneficiaries, the beneficiaries, but also it allows you to know that they just say can't get all the money and then blow all the money. You can have
Hmm.
thresholds and guidelines in place to show them how to utilize, maintain, and take advantage of the estate.
Yep. And that's another thing is leaving instructions for anything for your beneficiaries. Like, a lot of y'all have insurance, term insurance, whole life insurance, insurance at work, but you have these big large lump sums and you're saying I'm going to give this person $500,000, $600,000, $700,000, and they barely can manage $10,000.
Right.
You're setting them up for failure. You want to leave instructions. And what those instructions are could be, hey, you're not gonna, you can't spend no more than 30,000 a year or 20,000 a year, whatever the case may be, for the next whatever year, whatever decades, or whatever the case may be. You can even set it up where they only get like a distribution. Like you may lead them $800,000 and they only get like $2,000 a month for the rest of their life. You can set it up like that, but again, it's protection for generations is really what that should be, but or just protection for that generation. But again, there is a way you can set up those generations after that, right? After that. Now, Tim, that's what I saw in the email. I think you had some other stuff too that you wanted to talk about. Making sure.
Yeah, so but the end with the estate plan though, but they're gonna allow you, so if you have $30 million in your estate, they're gonna let you slide on 13.9 million, and then everything over that, then it's gonna be some taxes that's gonna be have to be paid.
Mm,
Um, so that's pretty much what that means. Now, it's other ways. This is why we always say finances and planning is a strategy, because it's ways that you can make all of this happen and have the lowest tax burden possible, but also continue to pass along the generational wealth amongst the family name, amongst the organization, amongst different things. But we got to be strategic versus just doing random things. And then we got to work with people that's going to help us make sure that we keep the money, but also maintain and grow the money.
right.
And then one of the things I wanted to add to just the conversation about taxes is that, because a lot of times we get so stressed out about taxes, thinking about the tax and then,
Mm,
going through the process, but we still just have to remember that one of the things that's most important is make sure you tackle and look at your finances, particularly taxes, with a strategy. And I think that's one of the keys that Tam was just mentioning when she did the breakdown. It still showed that you still gonna have $5,200 that you could got to be responsible paying the IRS without having a strategy. This is
mm-hmm.
why it's so important now, going to why Tam and Women in Linux mentioned why it's important to have high level skill sets, because what high level skill sets does is, one, it allows you to be in a situation where you have overhead, but then once you have overhead, that overhead can now get distributed to getting in certain rooms. And when you get in certain rooms, now you get a chance to get some guidance, advice, and counsel on, now how can I lower or lessen this $5,200. So it all ties together on why this stuff is important. But
Mm-hmm.
also it talks about why it's so important that you have a 9 to 5, but you also should be doing something outside of the 9 to 5 with the skills that you have, because that can also allow you the opportunity to reduce your taxable income. Now,
Right. And yeah, and then the other part to that is, some of y'all are like, well, I don't know what my skill sets are. Do you know how to read? That is a skill set. But- and the reason why I say that is because you can start reading books to on Audible, like using your voice to read books and so forth. You can start summarizing people's blogs. It's just so many other things that you can utilize that are not necessarily technical, but they also bring in some money on the side to help compensate some things in paying back taxes, or helping you start your business. Because now, when you got into that business, now you can look at other ways that you can maybe fund some of the stuff. Like, hey, I have a business. I'm in a suite, so I got to pay for a certain amount of space in that suite, or whatever the case may be. Maybe you got internet. Maybe you got maybe you're running some other business out of it. Whatever the case may be, but that's just another way for you all to start thinking just really outside the box. So before we hop another one, I just looked at this, right? I looked this up. I said, what are the tax strategies for high income earners? And it just kind of gave an overall summary of what that could be. Right. So the tax strategy for earning W-2. And it says HSA, contribute to a 529 plan, which I forgot about. If you got kids, that'll probably help you. Uh, claim tax credits. Max out your pre 401k. We said that. Keeping track of your taxable fringe benefits. Sell inherited real estate. Do estate planning, backdoor Roths, Tim, backdoor Roths, buy municipal bonds, donate to charity. I don't know what I don't know what create contribute to a super annuation. I've never seen contributing to an annuity work give you tax write off. You know what they talking about on that one, Tim?
I have no idea. I never heard of that.
Me either. I had to look that up. Invest in real estate. Your IRAs, invest in opportunity zones, contribute to a Roth, manage your equity compensation, meaning like you got RSUs and so forth. And of course, harvest investment losses, so tax loss harvesting. If you're investing in a brokerage account and HSA, everything we kind of talked about, we really don't. Being single, and making high income, you really don't get a lot of tax help on the W-2 side. It
Right.
only really comes on the entrepreneur side of everything, because you're getting, and then not to mention the state you live in.
Yeah,
That's
that has a
that's a
lot to do with it too.
the state you live in also contributes to that.
Well, I would say one thing about this list though is the list is good.
Mhm.
However, a lot of these has limitations.
Mhm.
Yep, and that's why. And here's the thing: it's about being in the know and then utilizing what you can utilize for you as the individual. So I think that's why it's important that when you think about just the tax system and your strategy, you really need to make sure that one, you do hire a professional. I think that's
Yep.
the first thing. And I want to do this disclaimer: we're not tax advisors, we're not tax planners. This is for information, education purposes only. Okay.
Yep. Yep.
So, but one of the things is that's why you do want to at some point want to hire a tax professional. I would recommend should do it before you start to even increase your income, because you should get a feel for the process and start building a relationship, because you're not going to stay where you're at. Your goal is to increase your income. You definitely want to get over the 250, 300,000. So because of that, you definitely want to just go ahead and start building that gap and start, I like to say, start vetting who's going to be that representative for you as the individual.
And we had to do another show on how to vet a tax strategist for folks, because I don't think anyone really knows how to vet one. And then two, not only how to vet one, but who, like, what are you looking for credential wise for a tax strategist and so forth. I think we should do a show on that one.
Perfect. I think that'll be good.
Yeah. So I was, while you was talking, I pulled up Chat GPT, right? And I said, create a tax strategy for a high earning W-2 employee. And they said that's usually making 200,000 or more. Focus on optimizing available deductions, maximizing tax advantage accounts, and strategically planning investments to reduce taxable income. All right. So here they talked about the 401k, and we said we want to go down this route, but they just mentioned it: the backdoor IRA, and then the mega backdoor Roth IRA. I mean Roth 401k. And then of course the HSA, and then tax efficient accounts like we talked about, tax loss harvesting. Invest in tax efficient index funds and ETFs. These generate fewer capital gains distributed compared to actively managed funds, helping reduce annual tax liabilities. Um, Here's another one: optimize deductions and itemize deductions. So, charitable contributions, mortgage interest, state and local taxes, They talked about that, and then consider deferred compensation plans, non-qualified deferred compensation, employee stock purchase options, and then they go on to talk about your manage your adjusted gross income for key thresholds. They talk about that and real estate investments. Back to real estate and utilize the qualified contribute charitable distributions, and then plan for state and specific tax strategies. Consider income shifting for dual residents. High earners in high tax states may explore dual residency options to lower tax burden to lower state tax burdens. This requires establishing primary residence in a lower tax state and meeting requirements to shift income sources legally. Right. And then that was it. So they just gave an example of what that could look like for you. The backdoor Roth IRA, the contribute to a that's a donor advised fund. I don't necessarily like the donor advised fund because that means my money is leaving going out of my money is leaving out of my pocket going to a charity that I don't own.
Right. Don't
uh
own, no control.
no own, no control. Tax efficient funds, and then utilize ESPPs with careful timing to manage tax impact. And then rentals. So it look like rentals is gonna be your thing. That's what it
Yeah,
looked like.
yeah, rentals and um um gosh, I can't even get the word. What's it called? When they bundle the real estate, I can't get the word.
When they bundle the real estate, you talking about when that be the REITs.
Yeah, the REITs. What is it called when you got everybody in the real estate group?
An investment
It's
group?
it's kind of like the private equity, but it's another name.
I don't know. Talking
It's a
about
real
kind of.
estate fund, but it's
Oh,
another name. The syndication. That's what I was
oh
trying.
yeah, yeah, yeah,
Yeah,
yeah.
real estate
Oh yeah,
syndication.
yeah. But again, no one talks about this. You guys go out here, and I'm encouraging you to make money, but um they don't tell you on your W2 side what to do tax strategy wise. And they also don't talk about okay, I can't I can make myself a consultant, but how do I need to set myself up so I don't get burdened tax wise and so forth. We'll say that for another show. But I just wanted to make sure we covered that. Most of that stuff. Somebody asked, is that chat GB? No, I don't think it's four. I don't think it's four. I'm pretty sure it's not. All right, Tim. I'm off my soapbox. I'm
Oh
off my
no,
soapbox.
you did fantastic job.
I'm off
Anything
my.
else you want to add or talk about as it comes to
Yeah,
wanting to, you know,
yeah. I got articles waiting. I was waiting. Hold on, let me go back and share my screen. I got articles waiting. So I pulled this up, and the title of this, um, I wish this would go away. No, let's all right, here we go. The Pentagon overhaul, 8 policy changes he's expected to make from Trump, and it's at the bottom down here. We talked about Trump, about the abortion, travel policy, troops on the home front, transgender troops, diversity efforts, Confederate base names, troops in Europe, Space Command headquarters. All right, this is big. All right, so this Space Command headquarters moving from Colorado, it's supposed to be in Colorado. It got canceled to move from Colorado to Alabama, but now they're thinking he's going to pick that back up and force Space Force to move to Alabama.
Mhm.
So that's going to change the landscape of really the Southeast.
Yep.
Like, so all that money that they're making out there, trust me, they're making plenty of money on Space Force out there. I mean, the Linux admins are making 200 plus easily, easily.
Mhm.
So they're gonna move those and probably center them in Huntsville, Alabama. So real estate wise, tax strategy wise, I will be looking at Alabama. I will be looking at what's going on around in and around Huntsville and get in now. Even if it's an old plaza, even if it's an old car wash, whatever the case may be, I'll be looking to get in that area. And not just in that area, but the surrounding counties, because people like to travel to work.
Mhm.
People don't mind an hour out, uh, an hour and a half out. Those I would be looking at the surroundings. So you don't have to look directly in Huntsville. You can look outside of Huntsville as well too, because people are gonna build. They're gonna build up homes and communities, and people need to eat, sleep, and have entertainment. Right. So I'll be looking in either direction where their base is at. Again, NASA is out there as well too. I'll be looking at that. All right, let's hit them in the head. We got the IRS changes, but let's talk about it, Tim. Gen X is gloomy, but their retirement reality may not bite. So one of they call Gen X the squeeze generation. Are you in a Gen Xer? Are you a millennial?
No, I'm Gen X.
You Gen X?
I'm an old
Oh,
head.
you're old head. All right. They're saying that I said, but the retirement reality may not bite. They said Gen X is often labeled the generation the least financially prepared for retirement. So I did a show, Tim, a while back where it was talking about how we move from pensions to 401ks. So the show is really good. We was watching a video and they were talking about how they phased out the pensions, and then one day people came to work and said, "Hey, you going into a 401k now." And
Mhm.
they didn't give them no education on it, nothing about the how to look at the returns, how to balance. That work had never been done before. So people built up 401ks in the video, they built up and then they took major losses once the 2008 crash hit, because they just no one never told them about how to balance or do a 70-30 portfolio or 60-40 portfolio or what have you, right? Or
Mhm.
what your risk of what your if you're risk averse, or you all the way in, you take your losses on the chin. So again, coming out of that, the parents had the pension, but the Gen Xers started were probably the second generation or first second generation of 401k,
Mhm.
fairly new. All right, so it says the Gen X is often labeled the generation least financially prepared for retirement. There's good evidence that many in this cohort are woefully behind in savings for a plethora of reasons. What is that plethora of reasons? All right, so from their perspective, we're considered the squeeze generation, Tim. Well, we're taking care of kids and parents. Well,
Mhm.
you got sick and siblings.
Mhm.
Let's not leave that out. You taking care of kids, parents, and siblings,
Mhm.
right? And yourself.
Yeah,
And
people
yourself.
tend to always forget that
Eh,
the caregiver needs care too.
Right. So nearly half of the Gen Xers say retirement savings are behind, and then they go into why. Okay, yeah. So Gen X was born 1965 to 1980, has led our nation's experiment in the shift away from the pension to the 401k. All right. requiring individuals to save and prepare for their own retirement. They are the first generation to rely primarily on their own individual savings through 401k like plans, and therefore we refer to them as the 401k experiment generation. They've been experimenting on us forever. We're it. All right. So more than 2 decades ago, employers began doing away with the defined benefit pensions and switching over to a 401k. Now, don't get me wrong, there are still um, people or companies that have pensions.
Right.
There are still companies that so far when I looked it up, it's only about 20 that
Mm-hmm.
still have pensions. All right. And D, you said don't forget about the childless aunts and uncles and godparents. Yep. And like it says, while pensions are still the norm for public sector, state, and municipal employers, they have all but vanished in the private sector. Right. Today, just 11% of the private employers offer pensions, compared to 35% in the 90s. All right, so one of the big concerns is that they may retire earlier than expected. People often retire for reasons beyond their control and so forth. But we're getting to that age. It says the reality of Gen X for has increasingly been noted in financial industry reports. For Gen Xers say they would need about 1.56 million in savings to retire comfortably, but to date, they have saved only an average of $109,000. More than 1 in 3 Gen Xers have dipped into their savings or taken a loan to pay their monthly bills. All right. And it also says, what can employers do to help? They can contribute more and match more.
Right.
They can contribute more and match more. So I brought this up for a reason. And it kind of goes back to the episode 124 that we had, where I talked about the 25% into your 401k. But for Gen Xers and really 40 and older, I'm going to encourage you to look for jobs that contribute more than 4% into your 401k. Really, you want to start looking at least 10% and more.
Mm-hmm.
And the reason why is because you're playing catch up with your retirement life, whenever that is. And anytime you can get someone to help you with that, it helps. And anytime that you can get someone or a way to help with the taxes as well too, that helps. So if you got an employer that can contribute more than just the 3%, I'm telling you, go look for the 10%. This is one of those strategies about being strategic about how you invest your job search and the time that you and the companies that you apply for. Now, the other part of that is if the employer is not contributing a large sum, 10% or more into your 401k, you need to get a big salary. So you can put 25% away, right? And hear me out. Investing in a brokerage account is another way to have a savings account. However, there is fluctuations in which you invest if you're investing in that could cause problems. So understand there's a strategy within that brokerage account as well. And Tim, I'm gonna turn that one over to you. If you're gonna use your savings account your brokerage account as a savings account, because a lot of people don't believe in high yield savings account. They like I could just get better returns by just doing Nvidia, Microsoft, or VU in my brokerage account and not even worry about the savings account.
I totally agree. I think that, but I still think no, that's not cookie cutter though, because I think
Yep.
so. In this case, if you're talking about Jeanette, somebody that's trying to play catch up, I think this goes right in line with your earlier question. Why we got to be mindful of why we're doing what we're doing when it comes to our money. Because if you're a Gen Xer and you working behind, let's just say you only have the 109,000 in your retirement or savings, then you absolutely need to leverage all possibilities, but you need to strategize it around how can you get your money to grow, but also how to not get emotionally distracted when the market change if you're going to put it into a brokerage account. I think that's why it's going to be more critical if you are behind, why you need to get a professional that can help you strategize better than you can yourself. I think that's really the key there. And I think like even you coming, you're sharing this, Women in Linux is sharing this. I think that's why now that we got to cut out all the fluff and the noise. But I think the key question is though, before we get there though, let's go to what Dee put in the comments. I think we first got to identify that at some point we got to start saying no to stuff.
Yep.
Because if you don't say no, what ends up happening, you're going to be the person or become the person that you're caring for and taking all your resources putting into now. So what does that look like? I'm not saying that you don't not love anyone. That's not what I'm saying. What I'm saying is though, you got to now get a little bit more strategic on what you're doing with your time and see how can I get a 2-for-1 to see who can I bring along a work with and we can get something going together.
Or you make them feel like this gift form, this 709.
Because I'm gonna go one step further, because a lot of times we're helping family members, but
Yep.
what we don't utilize is why not go get the paperwork to support they're now but dependent of us, and now we can get that as some of it as a write-off. But we don't utilize those tools because we only look at just doing, but we could be a little bit more strategic where we can still do but get a benefit out of doing.
Yep.
Meaning, so let's just say if you taking care of your mother, right? And you do everything for her, but it is a benefit that if you pay a certain percentage of help percentage wise, then you can actually write some of that off as a dependent, or you can claim her as a dependent, which also now lowers your standard deductions again. Because now you can file head of household. So it's those type of things.
But that don't you have to be in the same household to file that head of household?
Well, that depends.
Okay.
Yeah, so that depends. They could be in another address, but if you can look in the tax laws, but if you provide X amount of dependency for them, then you can write off some of that dependency. Or you can claim them as a dependent, but now they can't file taxes, but you can file taxes as them being your dependent. So it's those little nuanced things. What I'm saying though, we got to get a strategy around and see and figure out how can we make this work so we can get the biggest bang for our buck, where we can still provide and take care of our loved ones, but also be on track that we don't become the burden on anybody for our own self.
And that right there, this is another thing too. Oh man. So here's the other thing that we don't talk about is, and people talk about retirement, but retirement is a package, right? And in that package, you need to have a place to live. You got to have money to eat. You got to have pay property taxes. You got to have a day to day. But one big thing that people don't talk about is your insurance in retirement.
Yeah.
No matter how healthy you are, you still got to go to the doctor. You still got to get your eyes checked, your ears checked, feet, whatever the case may be. Maybe you are maybe you are a widow, and he or her who passed away has some benefits or something like that. But we also need to talk about the insurance Again, being strategic about your jobs
Mhm.
that can help you in the long run when you retire. Now, those of you that got military benefits, this don't apply to you. We got you. I ain't talking about
Right.
y'all. I ain't talking about y'all. But for the women and the men that didn't go to the military and you are approaching 40, what are you gonna do in retirement for insurance?
Mhm.
What does that look like? Have y'all seen the insurance costs? Monthly costs? All right. Now, why I mention that? This is where your state, federal, local come into play. You wonder why those people stay 30 and 40 years? It's not because, oh my goodness, we just love this job, but they have stayed because those jobs have benefits after retirement.
Right.
So, strategically speaking, you need to look for jobs that also offer benefits after retirement,
Right.
right? So what jobs are those? So I think is it Microsoft or Google that pays for your that has a retirement plan. I forget what it was. I think if the spouse passes away while they're working at Google, they still get their salary for 10 years or something like that. I forget what it was.
Yeah, that was Google.
Okay.
Google retirement their benefit plan is bonkers.
Mhm. Let me see if we can retirement plan. Let's see. All right, here we go. All right. Let's look at it. Let me look at this right here. So I'm looking. So there's I guess this guy. He's looking at it from all the U.S. Google employees are automatically rolled into a traditional 401k with up to 50% with a 50% up to 3% match and invested in a target date fund. And it says the IRS limits, and it goes into the pre-tax and so forth and so on, right? And let me blow that up some there. This is what I'm looking at here. But I'm looking to see what I'm looking to see after you retire from Google. Um, what it is. It says the IRS allows you as a Google employee to contribute as a Google employee. It didn't say as a Google employer. It says as a Google employee to contribute a maximum of 69,000 to your 401k across contributions types. The pre-tax, the Roth, the Google 401k, and the after-tax proportion. It says important reminder that an after-tax 401k is separate and different from contributing to a Roth 401k as described above. And then they say they have mega backdoor Roth IRA at Google. So Google has a mega backdoor Roth IRA, Tim. And it says and it says you can do what is called an in-plan conversion and convert these after-tax dollars into an actual Roth 401k, a tax-free maneuver. Then these funds won't just grow tax deferred. Those earnings will also be tax-free when you take the money out for retirement. Right? So they're talking about what the benefits are at Google. And I think what's important here to me that as an employee, the IRS allows you as a Google employee to do a maximum of 69,000 to your 401k across all the contributions types, right? the traditional pre-tax, the Roth contributions, the 401k tax, and the after-tax proportion. So that is that this mega backdoor Roth IRA. I think this is what I'm talking about is how to prepare yourself for afterwards. Right? Now, we talked about let's see if we can I looked this up before, Tim. Let me see if I can find it. I know the feds have a federal plan for insurance, but I want to know state plans after retirement insurance. That's what I want. I want to know what that is. Let me see
Well,
what go ahead.
I was gonna say while you're looking at I was just going to state kind of going back to the HSA. I think this goes right in that vein
Mhm.
where why the HSA is so important. Why I get it. People don't want to necessarily pay and had a high deductible, but I think it's a cheaper cost to do it now versus the wait, and then you got to pay the higher premiums every month to have insurance. Right. So I think that's gonna be the leverage because then you could utilize the buildup of the HSA to now be able to take care of a lot of your health needs and then don't necessarily have to touch your retirement. Because think about it, at least if you have the money set aside for health and you may not have had enough time to build the retirement pot, you at least got a pot that you can still take care of yourself and maintain yourself health wise and don't feel like you kind of picking between one or the other when you actually need both.
Yep. And the HSA has the benefits where up to 65 you can
Yep.
at the 65 you can use it for you can take money out. It's no RMDs on it, but it's taxable income coming out though.
Yep.
But you can use it for other things. And that's at 65. I thought it was 70, but it's at 65. So, some people have HSA plans that are $100,000, $200,000 on their HSA plans.
Yeah, that's the one thing I wish I took advantage of when I first heard about it was the
Mm.
HSA.
I mean, my HSA was returning 13,000. But you know what? Here's a true story right here on this HSA thing. And luckily I'm a checker, right? So in my HSA, what I do, uh, I was doing it every day because I was just trying to fill out something. But now I've cut it down to once every 2 weeks. Somebody probably do once a month.
Mhm.
I go in and I check all my accounts, my HSAs, my 401k, whatever, whatever, right? Because everybody don't have a API where I can pull that information in and go from there, right? However, I was in my HSA one day and it says, "Hey, we're trying to get you to we need approval for this $2,000 that need to be transferred out." I'm like, I didn't say nothing about no $2,000 that need to be transferred out. Uh, I I I didn't authorize that, so I called them, and the company I remember had got hacked, and they were trying to transfer $2,000 out of my HSA to an account. I'm like, no, that ain't me. So I had to change everything because they was trying to get me for $2,000, and I took off whatever that was, change email, everything. I changed everything, and my account said dormant for like 3 weeks. I couldn't contribute to it or nothing like that. But I say all that to say is y'all should look at your accounts. Like, and what's so funny is 2 days prior to that, that wasn't there. But on the third day, um, I just went in to check and I saw it. So yeah, somebody was trying to steal my little money for my HSA. I was like, "Oh, you was trying to get me for 2 grand, dog? Come on now." Don't do a sister like that, right? So again, watch one lesson learned. Watch your accounts. People tell y'all don't check y'all accounts every day. This, then check your accounts as often as you feel like it. That's what I'm saying. As often as you feel like it, and literally make a spreadsheet of what's in there, and then go check. To and another thing too is look at when you go check your accounts. Look at the activity. Like, go look and see when was the last time somebody logged in, set up your MFA on your account. Also, another thing too is when you're looking at those accounts and stuff like that, and you want to automate contributions to those accounts and stuff like that, make sure that you also checking to see like that automation one is working and it's the same amount. Like, like, hey, you're contributing 100, and you need to make sure that 100 made it there whenever it's supposed to make it there. You need to log in and check that, because people will try to steal from your account. I have not had that happen to me on a brokerage account, but I have had that happen to me on my HSA account. They tried to take my little dollars, and I was like, "Oh no, I done worked hard to put that $2,000 in there. Don't try to take from me." So just an FYI on that one, folks. Just keeping in mind. Now I did look at Florida's state plan, but that I wasn't happy with that one. I know the federal one, in retirement you get insurance. I think is it Blue Cross Blue Shield or Aetna, you get insurance. Um Insurance. Yeah. Pull this over. So federal employees right here, dental and vision insurance program. Yeah, so it's available to federal and postal employees, retirees, and their eligible family members on an enrollee pay all basis. So you get dental and vision. You also get health benefits as well too. So again, looking for ways to leverage where you don't have to pay in retirement, it's going to be crucial to you. I don't know if y'all looked at see what the average cost is for retirement. What is the average cost of insurance for 60 and older? Let's see. I'm using Chat GPT to tell me. It's search four sites, and it's saying that it looks like the plan. It looks like a $1,000 a month to about 3,000 a month.
Mhm.
$1,000 a month to 3,000 a month just for your insurance. Now, we're gonna talk about the medicine. We're gonna talk about if you got sick or you need X-rays, scans, whatever the case may be, and the insurance don't cover all of that. So you need to factor in the cost of insurance in your retirement. So if we want to do the extreme, you need to factor in another $24,000 a year. Is that right? Or no? Well, yeah, yeah. If we want to go say $2,000 a month,
Yep, 2,000 a month.
24,000 a year out of your pocket. And let's say you live 24,000, and say you live for another 20 years. Right? So that's going to be another 48, about another $50,000. I mean, not
Mm.
50,000. It's going to be more
About
than that.
enough
About
500K.
500,
Yeah.
500K, another half a million. So that 2 million that you got in retirement, that's probably sitting in the taxable 401k or tax deferred account, coming out of that, you still need to account for $500,000 in that,
Mm-hmm.
right? So you return that $500,000 in your account is not gonna help you.
Right. Because if you just factor in just the insurance alone, you're already back at zero. So it
You
makes
just paying
sense.
for insurance.
So when you think about when the industry states that
Hmm.
you need at least 2.5 for a comfortable retirement, you take 5 off the top, you still got 2 million for just your living, your standard of living.
Mm-hmm. Plus tax, depending on how that 2.5 is set up. So
That's correct.
I'm just giving you all just things to think about. I want to make sure that you all had it from a W-2 perspective. I don't think you all have thought about this from a W-2 perspective. And what your options are, right? What your options are in your interviews, in your when you get ready to talk to the employer about your job offer. You need to be looking at like uh, what what type of 401k do they have set up? Are there matches? Do they have a HSA or FSA? Are they contributing to automatically? Did they give you 3%? What does it look like for even education wise, right? Because
Mhm,
that's money that you don't want to spend. You need to ask all these questions, and that's right, D. Those visits 3 times those visits 3 times 3x in retirement. Yeah. And then not let's not forget, you still taking care of other people
right.
amongst all of that. So suppose you got a family member that don't have any insurance. I don't know what's gonna happen. It's not called the Obama Act anymore, is it? What is it called now? It's called something else. But what's gonna happen with those that don't have insurance, or your insurance runs out? It's like we can't keep paying your medical bills anymore.
Mhm.
What happens then? What are you gonna do then? That's all I had, Tim. I just want to put this out here on people's mind. We're going into 2025. We see the election. You guys need to start thinking strategically, stop reacting, and start planning and be strategic. And I'm not telling you to plan for a whole year. Let's let's make a plan. Let's spend 30 days on it and then go from there. You know what? With Social Security, Afia, uh, that was another big thing that was coming out of this. Is of course they expected Social Security in 2034 to be your if you're supposed to get $1,000, reduce it down by 20%. You're only gonna get $800. So for every thousand, it's gonna be reduced by 20%, right? So when you start looking at it from that perspective, you may end up having to save more. So now that 2.5 million is gonna shoot up
Yeah.
because and in this 2.5 million, let me be clear, I'm not including Social Security. This is just you. It's not Social Security and your 401k. This is just you. I just want to make that clear and make sure I get to what's in the back check here.
I totally agree. I don't think we should include Social Security in none of your estimations. You should just take it as extra if it's still there.
Mm-hmm. You
But
treat it like a scratch off.
yeah.
Ooh, I won $1,000.
Oh, $1,000 just came in. Oh, that's
Yeah,
great.
that's great. Yeah. So I don't include Social Security in this 2.5 where that coming up with that again, a strategic 30-day plan and then create that as your foundation, and then put that into autopilot. Now you may have to make some adjustments depending on presidents, depending on funds and how they move and whatnot. But your foundational plan to 2.5 million should be automated.
Mm-hmm.
And let's not forget, your plan should include increasing your job performance and skill set, including your sign-on bonuses. Sign-on bonuses, I think, uplift you all personally, especially when you getting big chunks at 30,000, 15,000, 40,000, 50,000. When you're getting those big chunks, you just immediately pull them out and just go put them somewhere and save them. Like that, like I didn't even see that. Like it don't even see me. And you can coordinate that with people when they say your sign-on bonus, we're gonna send you, we're gonna give you a sign-on bonus for whatever. But most of the time, we're not in a space where we get that sign-on bonus. We have to use it to move. We don't have $10,000 of our own money to move. We got to use it to move, or we got to use it to pay off something or whatever the case may be. We're not in that space. So I hope this helped. Tim, you got anything you want to add before we get out of here?
No, I just want to tell everyone, just keep, stay focused on what you need to do for you. Don't let none of the distractions take you off of your goal, your focus, your direction, and just look to understand that as we continue to move forward, just think about what do you want to do, and then, like Tam said when we first started the stream, re-engineer, think about the end goal, and then just work your way backwards on how you want to get there. I think that's a good way, because then you got the goal in mind, and now you're working on how do I get to said goal, and then just execute. Continue to execute, continue to do the work, and continue to expand your knowledge base, because nobody has your own individual plan, know your plan better than you do. So now it's just a matter of trying to put all the pieces together. And nobody said it's going to be hard, but as you continue to work on it, it'll all work itself out in the end.
Yep. And I'll add to this: get around like-minded people at least once a month, or stay around them all year, but at least once a month. Find some people that's talking about investing strategically, have the same goals or at least mindset to get to the next level. And when I say to the next level is the next level where it's easy. It's a autopilot. You go on a trip, you're not gonna die because you went on a trip, or you're not one paycheck away from being homeless. You have a cushion and a good foundation. Like a friend of ours, we talked about what is it? w- the- Does it make sense to have uh 20,000 readily available, or 100,000 readily available? And I talked about this before about the catastrophic event. If the hurricane comes through and wipes out your property, um, if you had just $5,000 saved up, it's a drop in the bucket to get somebody to come and clean and move and haul stuff out your house, get your floors redone, wait for insurance to do X, Y, and Z. So being able to probably, and we were saying, at least have a minimum of $100,000 liquid ready to go at any point in time. And that could be between a brokerage account, a high yield savings account, stocks, or what have you. But at any point in time, you should be ready to go with that however you need to get it, right? If you got it in your brokerage accounts, you got some time where you can move or whatnot. But if you got to go and wait 2 weeks for a delivery, this that you may not be able to move how you want to, or get hotel rooms or what have you. But again, being ready. We said a minimum of 75, but 100 is really the goal. All right, Tim.
All right, women in lineage. Well, I thank everyone. Thanks for having me as always. I think it's a joy, and I think we probably can do this at least once a month where
Yep.
we just really focus on the plan at hand and continue to let people and just spread awareness. I think that's the key, awareness. And you all make sure you just bring your questions, some concerns, or some things you may have heard, and we'll look to do what we can to get those things answered, but
Yep.
also continue to provide you the guidance, and hopefully it guides you and you hit the goals and dreams that you have for yourself. So I want to thank you and Dee for always inviting me over, and catch you all on the next one.
All right, thank you. And I appreciate y'all for coming out.